David was on November of last year. He had 3 winners for you, all up actually at least 22% in that period. JP Morgan, let's kick off with that one. Return of 28%.
I would make this a top pick today if I hadn't chosen it 3 times, in the last year. Financials, our themes have been the same really over the last 18 months. Financials will benefit from a reflation cycle probably for 5 or 6 years. And the U.S. financials are trading about 1 times their book value. They've traded as high as 3 times their book value in the past. There's multiple things driving their earnings: rising rates, less regulation, better capital markets. And they've been held back from paying dividends. They're now being able to accelerate dividend growth. No change to that story. And they're just the best bank in the U.S.
Okay, and we got your next one, Texas Instruments. We're back to microelectronic devices, and this one a return of 28%.
Yeah, Internet of Things. This has been a theme. We're all about finding secular long-term themes that could go on for years, getting to the best companies and staying in them as long as they work and as long as the fundamentals are there. And Texas Instruments, stuff goes into all kinds of connected devices. And once they get developed and designed in, the company will just keep using them for 5 or 6 or 7 years. These aren't things that go through big upgrade cycles, so they're highly profitable.
And it's Texas Instruments, presumably their technology is at the front.
But these are semiconductors for like refrigerators or go into cars. They're not things that are high tech.
They keep changing.
Right, exactly. So they have a long life cycle. So once they've been developed and start to manufacture them, they get designed in. They aren't changing, in 8 months and have a lot of redesign that has to take place.
It's almost like valves or gaskets. You don't need to have the latest model all the time.
Right. And semiconductors are the copper of today. They go into everything. And the semiconductor cycle looks as though it still has significant legs in front of it. So I think you have to be there if you believe that we're going to keep connecting everything to the internet, when we are.
And let's stick with that industrial theme. Ingersoll Rand, this one went up, return of 23%.
Yeah, we really continue to like the industrial sector. One, because machinery is all slowly becoming connected. The capital stock of the U.S. economy is the oldest it's been in history. Companies weren't spending.
Buying back shares instead.
Right. And now, in the last year, companies who are spending are being rewarded by their share prices going up. And business optimism, we know, has gone up a lot. And there's incentive for people to spend because they see a more certain future for business in the U.S. So we're going to talk about another industrial today. But we quite like the industrial sector and the companies that benefit from a stronger industrial sector. This is also a sector that does well later in the cycle, and which is, we're probably a little later in the business cycle right now.
What about GE? That's been such a disappointment for investors. If we look at a 10-year chart, you're not buying that story.
No. If you're in a sector, first of all, the industrials are the most under-owned sector by hedge funds in the U.S. However, it's been performing well for 2 years. If you're in a bull market and you find a stock that's getting crushed in a bull market, it tells you that despite people being interested in looking through the rubble, they look at that and go, yeah, but I'm going to get rid of that one, right? So they just haven't been able to execute. And if you were to look at the industrial sector and took GE out, which is a huge part of the sector, the chart, would look like this.
So GE, you're not getting in, a work in progress.
I don't know. I'd be a seller today.
Okay. Okay, we got to take a break. We're going to be back with David Burrows, taking your questions on North American large caps. Give David a call, 1-855-326-6266.